Everybody is a financial genius in the bull market because everything you touch goes up, so it looks like you know everything about investing your money. But the real test of financial intelligence is what happens when things go down, because the reality is nothing can go straight up. Not even stocks. The stock market is the most accessible place to build your wealth. Now, for the last couple years now, the stock market has been very weird, where if you understood what was going on and you were able to get in at the right time, you were able to make a lot of money very quickly. But if you didn't know what was going on, or if you made some bad decisions, or if you didn't invest your money, well, then you weren't able to capitalize on all of this. So in this video, I want to go over some things that you need to understand about the stock market. That way you can make the wealth yourself. Our economy in 2020 did not do very good. I mean, we were shut down for a part of it and people were not shopping because of the pandemic. And recently, the fourth quarter economic results came out and they said that our United States economy grew slower than expected. And so our economy is still hurting. We have millions of people that are out of a job. We have millions of people still relying on unemployment. We have a multi-trillion-dollar stimulus plan in the works. And so our economy is hurting. And hopefully, we're starting to turn the corner now, where we're coming out of this pandemic, we're coming out of this recession. Businesses are hopefully going to start opening up even more, so people will start to go back to work, so people will start to earn more money, so people will have more money to spend, so we don't have to keep printing our way out of this recession. But there are some things that I'm concerned about, especially when it comes to the stock market. The stock market is a place where you and I can go and invest our money based on what we think is going to happen in the economy in the future. And the stock market has been rallying since mid-2020, even when we were in the midst of this pandemic. The reason why is because people believed that our economy would recover quickly and come out of this pandemic and be like normal. The issue that could happen now is we're coming out of this pandemic and our economy is starting to recover and the stock market has already priced in a full recovery. But what happens if our economy doesn't recover as fast as we would like? What happens if our economy continues to struggle for a while? Or what happens if these vaccines don't work as good as people hope they would? We're already extending eviction moratoriums, which means landlords cannot kick out tenants that are not paying rent. We're already extending moratoriums against foreclosures, which means banks cannot foreclose on homeowners that are not paying their mortgages. We've seen an absolute insane amount of money printing happen over the last year. And unfortunately, we've seen the stock market almost turn into a casino. You know, I've been covering the GameStop and the Reddit and the Wall Street Bet story on our YouTube channel, so you might have already seen me talk about it. But there's more to the story than just people making investing decisions. It's people trying to stick it to the man on Wall Street, saying if Wall Street can do certain things, how come us retail traders can't do the same thing? The issue that I'm worried this could create is people going into investing into the stock market hoping now for unreasonable returns, hoping for 1,000% returns in a year or 100% returns in a day, because you have all these new traders entering the market and that's all they've seen. Now, before we go any further, let me just kind of clarify this for a second, because what we've seen happen over the last month or so is really not normal. It is not normal to see 1,000% price growth in stocks. It is not normal to see people rallying together and create this short squeeze. It is not normal to see that happen. Everything that I talk about on this channel is all about making sound financial investments. That way you can sustainably grow your money and build wealth over time. Now, there are people that can make money trading. There are ways you can make money doing risky investments. That's not what I talk about. But the reason these things have been so popular and the reason I've been talking about them, it's not because they're sound financial investments, it's understanding what's fair and what's right. You, as a trader, as an investor in a free market, should have the rights to trade freely. For your wallet's sake, I'm not advocating for you to be a speculative trader. I'm not advocating for you to make risky investing decisions. I'm not advocating you to go into debt up to your eyeballs to buy a random stock or a random cryptocurrency hoping that you can get rich overnight. I want you to understand how to build wealth sustainably. That way you can build wealth for the long term. Investing in the stock market has transformed over the last century. A century ago, if you wanted to invest in the stock market, it was almost exclusively reserved for wealthy people and rich people because it wasn't easy to invest in stocks. You couldn't just go onto a phone and invest in stocks whenever you wanted because there was no cell phones around then. If you wanted to invest in stocks 100 years ago, you would have to work with a broker and talk to them about which company you want to invest in. They would have to fill up a form and then they would have to go through a whole bunch of different steps and then they would let you buy shares of a certain company. Then in the 1980s came this whole idea of a personal computer computer, and companies like E-Trade came out and they let people buy stocks on a computer for the first time in history. Then in the 2010s, with the growth of technology and the internet and our cell phones, came commission-free brokerages like Robinhood and Webull, which let you buy and sell stocks without paying a penny in commissions. This new commission-free trading by Robinhood and Webull eventually pushed your traditional brokerages like Charles Schwab and TD Ameritrade and E-Trade to remove their commissions for trading stocks. And so now you had all these brokerages which allowed you to buy and sell stocks at the convenience of your phone or your computer without paying a penny in commissions. And then in 2020 came this pandemic and the entire country shut down. So nobody had a job, nobody had work to go to because the entire country was shut down and the stock market was in free fall. This is when you had millions of people sitting at home with nothing to do who decided, this would be a good time for me to open a stock brokerage account. And you saw the largest influx ever, the fastest influx of retail traders entering the market. And so you saw millions and millions of people go out and they would open up a Robinhood account or a Webull account or a Charles Schwab account or an E-Trade account. And now you had regular people learning about stock market investing and throwing money into the stock market. Now, I'm a financial nerd. I don't know many people that would be as happy as I was when I saw millions of people open up their first stock brokerage account, but that was great. You had so many more people interested in becoming financially educated, and you had millions of people now, retail traders, regular people that were buying stocks when they were dirt cheap when the 2020 stock market crash happened, and Wall Street wasn't very happy when that happened. You had big hedge fund managers coming out saying that these mom and pop traders that are buying stocks have no idea what they're doing and they're going to lose everything. But what we saw happen towards the end of 2020 was the economy started to recover, and with that the stock market recovered, and the people that won were the mom and pop traders, the retail investors, because they were the first movers. They were the ones that were buying stocks when it was dirt cheap, and Wall Street was late to the game, and Wall Street was mad that they missed the rally. Then come 2021 and the retail traders are feeling confident about trading stocks because they had a great year in 2020, and then they discovered this thing called the short squeeze, where they found heavily shorted companies like GameStop, AMC, BlackBerry, and they started talking about why they were buying these stocks to hopefully trigger a short squeeze, which would cause the price of these stocks to rally, because now all the companies and the people that were shorting these stocks would be forced to cover their positions and they would be forced to buy the stock, and that would force the stock price to go up even more. And the retail traders were right. Again, they beat Wall Street at their own game, and the retail traders walked away making a lot of money because these stocks soared and they triggered the short squeeze, which is exactly what they wanted. Again, if you're subscribed to our YouTube channel, you follow our Instagram page, or you read our daily financial newsletter, you know that, again, I'm a kind of a financial nerd, and there's not many people that get excited about this and as riled up about this as me, because I love the idea of retail traders, regular people getting financially educated, learning about investing and making money in the market, especially when you're beating Wall Street at their own game. Here's where I'm worried. There's a lot of speculation, there's a lot of greed, and there's a lot of people thinking that they cannot lose in this market, and it's also fueled with a lot of debt. We have the highest margin in the history of time right now, which means we have the highest number of people trading on debt in their brokerage accounts, with all this debt going into the market. And when you have this FOMO or greed that's fueled with debt, that can cause a lot of financial pain when you don't know what you're doing and when you let things get out of hand. If you made a ton of money in 2020 and 2021, I am happy for you. What I want you to do now is understand how to protect your money, because nothing can go straight up forever. I love the idea of young people getting money, and I love the idea of regular people beating Wall Street in their own game, but now you gotta be smart with what you're doing. The stock market is not supposed to be a casino, and it's very easy to get into this mindset of believing that when you're winning that you can't ever lose. It's called the hot hand fallacy, because every time you roll the dice you win, and when you win, what do? You bet bigger and you win more, and now you bet even bigger, so you win more, and eventually this roll is not going to work the way you planned. And so you need a plan for that. This is where having a smart strategy comes into play, because you cannot believe that every move that you're going to make is going to win. There's a big difference between trading and investing. Trading is when you buy an investment with the goal of selling it within less than a year. Investing is when you buy something because you believe in its value, you believe in its fundamentals, and you believe in the long-term potential of this investment, and so you plan on buying this investment for at least a year. Long-term sustainable wealth is built through investing. It's not built through trading. Now, trading can make you a lot of money very quickly. We saw it happen in early 2021. We saw it happen in 2020. But what I need you to understand now is as you're making this money, be smart with it. What can you do with this money? That way you can protect it and that way you can keep it, because no market can go up forever. Things change. You want to make sure you're set up and in a position to protect yourself and protect your money and protect your newfound wealth when the market changes, because that's what happens. The market changes. I don't know when it'll be. It can happen in a week, a month, a year, a few years from now, but this is something you got to keep in the back of your mind. The people that lose everything when a market change happens are not the people that are investing their money based on sound fundamentals for long-term wealth. It's the people that are investing their money based on greed and speculation, and all of this is fueled by debt. When people start to buy up an asset and you see this asset price rise, it doesn't matter which asset we're talking about, whether it's stocks or real estate or tulips, when this asset price starts to soar and people start buying this asset, not because they believe in the underlying value of this asset, or not because they have a strategy, or not because they believe in the fundamentals of this asset, but just because they hope to get rich quick because they see everybody else getting rich doing it. And so what they do is now they start going into debt. They refinance their homes to throw all this money into this asset without knowing what this asset really is, just to get rich quick. That's how you see bubbles form. That's what causes euphoria, and that's what causes crashes. Now, the people that were the first movers, that were the first to come in, got rich because they saw this bubble form and they got out before this thing crashed, hopefully. But the people that lose everything are now the people that come in hoping they get rich quick. They buy at the top, they leverage up everything, they go into debt up to their eyeballs, and just buy this asset without knowing what they're doing. And then when the bubble pops, they're the ones holding nothing and just a whole bunch of debt. The first financial bubble ever recorded was the tulip bubble back around the 1700s in Holland, because in the Netherlands, the Holland area, when tulips were first introduced, the farmers thought it was a beautiful flower, and so they started buying up this flower, and slowly the price of this tulip started to go up. And as the price of this tulip started to go up, that's when speculators were like, wow, I can't believe how much money these farmers are making buying these tulips. And so speculators started buying the tulips. Then came the financial people, and they were like, wow, the price of tulips keep going up. So now they started creating tulip derivatives. And we're talking about tulip, the flower. And so now you have these tulip contracts and these tulip derivatives, and the price of tulips keep going up, and the farmers are like, why are tulips so expensive? And so now it got to the point where people, regular people, were financing their homes. They were selling their homes. That way they could take the cash and just buy one tulip bulb. It got to the point where one tulip bulb was worth the price of one house, because people thought the price of tulips could never go down, because this kept going on for years and people were getting rich just owning tulips. But then it got to the point where tulip prices got so high because of all this money and all this debt that was created going into the price of tulips, where nobody actually wanted to buy the underlying value. Nobody wanted to buy the tulips. The farmers had all these tulips that were worth all this money, and they created this auction to sell these tulips, but nobody came to buy the tulips. It looks like people were just buying these tulips on paper because they were hoping to get rich quick. And so when the farmers realized that nobody wanted to buy the tulips, that's when they had to start cutting the price of tulips. And when that happened, the tulip price crashed, and everybody who was buying tulips and selling their homes to buy tulips and going into debt to buy tulips lost everything. I'm worried that we could see something similar happen, because we have so many people buying assets, stocks, cryptocurrency, not because they believe in the underlying value of what they're buying, but just because they want to get rich quick. And so they're seeing what everyone else is buying, and then they start buying, and then they leverage up their bets with margin, with debt. And now you have people that are refinancing their homes to go into debt to buy these assets, not because they believe in the asset, but just because they think that they can get rich quick. From a more fundamental perspective, this is where things are really interesting, because our economy is recovering. Is it recovering as fast as we would like? No. But if our economy continues to recover, that could help support a higher stock market. But if the economy doesn't recover as fast as we would like, that could cause real problems and pain in the stock market, because now our economy isn't growing as fast as we would like, and the stock market has already priced in a full economic recovery. But this is really like an onion with a whole lot of layers, because the second layer of this onion is that there's so much money out there. We had so much money printed in 2020 and 2021. We have all these stimulus programs created, and so we have all this kind of like free cheap money being injected into our economy. And where does this money go? It eventually flows into assets. And so now people have more money, so they're just throwing this money into the stock market, into the real estate market, and so the price of these assets are naturally going to go up because we have so much money in our economy, in our economic circulation. The next layer after that is we have so much cheap debt out there. I mean, margin accounts are letting people borrow money sometimes at 2.5%. And so if you can grow your money faster than 2.5%, then you can beat the margin, you can beat the bank, and keep the spread for yourself. And so we have all this debt that is going into the market. And it's not just retail traders who are using this margin and using this debt, it's institutions as well. Institutions can borrow hundreds of millions of dollars at 3% a year and then just throw this money into the market. If you can get 3% a year on your money, then you can make a lot of profit on this money because you're borrowing hundreds of millions of dollars from somebody else and you get to keep all the profits. And so now in the market that we're seeing, where some people are able to see 100% returns in a month, if you can make 100% return and just pay your bank 3%, the other 97% is yours. But again, this goes back to the same core issue. It is not sustainable to see 100% returns every single month. It is not sustainable to see a stock go up by 1700% in a month. It is not sustainable to continue leveraging up investments and buying random assets without knowing the value or the fundamentals or why you're investing. It is not sustainable to have a whole bunch of greed and speculation fueled with debt without knowing what you're doing and just have the market keep going up. That's why over the long term, the people that win sustainably and consistently are not the people that are trading on emotion and speculation and greed. It's the people that are investing based on value, based on fundamentals, based on building long-term wealth. Personally, I'm a big believer in the United States. We've been able to overcome any hurdle we had to come across for the last hundreds of years, and we have no economic data stating otherwise why you shouldn't believe in the United States economy. But where I am concerned is what happens if you have made a ton of money and now you just keep leveraging it up with this hot hand fallacy and you just keep rolling the dice and you keep doing it and you keep making risky investments and then some of the risky investments don't work out. If you made a ton of money, great. I am happy for you. Now, please use your money smartly. Be smart with the money that you made. Be smart with your newfound wealth and use it in a way that's going to help build you sustainable wealth. That way you can keep this money. We're going to jump back into the video in just a second. But before we do, I want to tell you very briefly about Market Insiders, our investing coaching program. If you've been thinking about investing your money into the stock market, the real estate market, or the cryptocurrency market, and you're looking for some extra guidance, this is what Market Insiders was created for. It is not a class. Market Insiders is a coaching program where every week you get access to a real estate class, a stock market class, and a cryptocurrency class, which is live, led by one of our investing coaches. Our investing coaches are not investing gurus. These are real investors who have been investing for years, they've gotten great returns, and they have the money behind them. I'm talking about hundreds of thousands, if not millions of dollars invested themselves, and they're teaching from their experiences and their failures. That way you can learn from them every single week. Now, the cool thing about Market Insiders is you get access to more than just the weekly coaching. You get the weekly investing coaching, you get access to all of our previous recordings, you get access to our investing classes, and you also get access to our private Discord community. That way you can chat with other investors. So if you're trying to get started as an investor in the stock market, the real estate market, or the cryptocurrency market, or you're trying to figure out how you can be a better investor and get better returns, the Market Insiders is for you. That way you can get that kind of handheld coaching guidance, because now it's not just a class where you're going to be left hopeless trying to figure it out for yourself. Every week you're going to get access to stock market, real estate, and cryptocurrency coaching sessions, and it's all included. Now, if you're skeptical about all this, I get it. That's why you don't have to pay a penny today. You can try out Market Insiders for free with our 10-day trial. During the 10-day trial, you'll get access to everything. You can join the coaching calls, you can watch the previous recordings, you can attend the classes, you can go through the Discord and chat in there, you can ask your questions, and then you can see if it's right for you. If during those 10 days you realize, I hate this sucks, well, then you can quit and it's not gonna cost you a penny. But if you go through it and you say, wow, this is amazing, I'm blown away by the education, well then you can stay. And if you decide to stay, it's not going to cost you an arm and a leg. Market Insiders cost less than the cost of going out to eat. It costs less than $30 a month. So if you want to try it out, I'll put the link to how you can learn more and join Market Insiders with a free trial in the description below. It was very important to me that you feel comfortable investing in your financial education. That's why I wanted to make sure that you had nothing to lose and everything to gain, which is why if you want to learn more, you can get started with a free trial. That way you don't have to commit to spending a penny until you know if it's right for you or not. So if you want to learn more and try out Market Insiders and see if it's right for you, I'll put the link to where you can get started with your free trial in the description below. Here's a quick summary of what we've been seeing happen in the stock market for the last year and a half. Back in February 2020, the stock market was breaking brand new record highs. Then came this pandemic, the economy shut down, and then in March 2020, we saw the stock market crash at record fast speeds. It was the fastest stock market sell-off that we have ever seen in the history of time. It even broke the Great Depression, and so we had the stock market in free fall back in March 2020. That's when the Federal Reserve Bank opened their money printer, and then it started flooding the markets with free money, and we started to see the market start to turn around in late March 2020. By August of 2020, we saw the stock market not only recover from all of its March and April crashes, we saw the stock market break brand new record highs in August of 2020. Then in September 2020, we saw a couple of changes happen in the economy, and that's when we started to see another stock market pullback. A lot of people talked about this as a 2.0 crash in September and October of 2020, where we saw 2 months of just the stock market tanking. And then in late October, we saw the stock market turn around quickly, and then we saw the stock market break brand new record highs in October. And then in March 2021, the Biden administration passed another stimulus bill, which injected another $2 trillion into the economy after 2 stimulus bills passed by Donald Trump in 2020. And then in July 2021, this is where things get interesting. In July 2021, we saw one of the worst days in the stock market in almost a year because of worries of this pandemic coming back, because of this virus resurging, because of potential lockdowns happening around the country. And so people were getting worried about that and all this inflation that we're seeing around us. And so we saw a massive one-day sell-off. Then, just a few days later, in the same week, we saw the stock market come back and break brand new record highs. This is where people are really starting to get worried about the economy and the stock market. People are worried about this pandemic coming back because you're seeing countries across the world go back into lockdown. Like Australia has reimposed some of their restrictions because of this pandemic. And then you have people worried about inflation because we're seeing the price of everything around us keep going up, and the Federal Reserve Bank and the government keep saying that this is transitory, but at the same time it's becoming harder for people to go out and afford their groceries. So people are not sure what's going on with inflation, and so people are naturally worried. What should I be doing with my stock market portfolio? Should I be cashing out? So if you have money in the market right now and you're trying to decide if this is the right time for you to sell and cash out, there's a few things you got to ask yourself. If you're trying to decide if this is the time for you to cash out and sell, there's 3 things you got to ask yourself. First, you have to know exactly what your strategy is in the market. I'm going to be talking about that. Second, depending on what your strategy is, you got to decide if this is the right time for you to sell. And then third, you also have to understand what's coming next. So let's start by diving into number 1 and really understanding what your strategy is in the stock market. For a lot of new people in the stock market, their strategy is, let me find a hot stock, hopefully make some money on it, and sell for a profit. But that's not really a stock market strategy. When it comes to investing your money, there are generally 2 different ways that you can invest your money, 2 different broad sets of strategies. You have the active way and then the passive way. Within the active way, you have 2 different sub-strategies. You have trading and then you have investing. So trading is when you hold on to a stock for less than a year. You're trying to make a quick buck and you're just trying to flip a stock. You don't really care about the stock's fundamentals or really anything like that. You're just trying to find a hot stock and sell it for a profit. The second way that you can be an active investor is now if you're trying to find undervalued companies. So you're spending a lot of time doing research on companies, you're reading the earnings reports, and you're trying to find a company that's undervalued that you believe in, and then you're going to buy this company and you're going to own it for the long term. I'm personally not a trader. It's more like gambling to me. Now, you can make a lot of money trading, but it's not for me. So for the purposes of this video, I'm not going to be talking about this. I'm going to be talking about actually investing your money into companies that you believe in for the long term. So that's active investing. On the passive side, the passive investing strategy is now where you're not trying to find an individual company. You're investing in things like ETFs. ETFs. So an ETF is a basket of stocks. It stands for Exchange Traded Fund, and you can think of it literally like a basket or a group of stocks, where now you don't have to worry about trying to find the perfect company or the perfect stock. You're now going to invest in a fund that's going to give you exposure to a whole bunch of stocks. The advantage with this now is you don't have to worry about trying to find the perfect company, and you don't have to worry about doing all the research. So you don't have to worry about putting all the time and taking on all the risk, because if you invest your money into the wrong company and this company goes bankrupt, well, there goes your investment. The whole idea behind investing your money passively in ETFs is this is the way for you to invest your money into the stock market without spending all the time, without having to do all the research of investing your money in the stock market. Because ETFs, the whole idea behind it is now you can invest your money in the stock market and get the stock market returns without putting in all that work. Over the last century, the stock market has gone up by around 10% a year. But at the same time, so many people lose money in the market because they don't understand how to invest their money. They trade on emotions, or they invest on emotions. They find something that they like, they don't have a strategy, they buy it, they see their portfolio go down a little bit, and then they panic, and then they sell. You don't want to be one of those people. And so if you don't want to invest all this time and research trying to understand the stock market, ETFs and passive investing is an easy and great way to go, because now all you got to do is keep investing your money into these ETFs that give you exposure to the stock market. And now when the stock market goes up, your portfolio goes up. The stock market goes down, your portfolio goes down. But if you believe in the stock market and the economy, this is an easy way for you to continually passively invest your money and compound your money without putting in any work. So if this is you right here and you have no plans to retire in the next 10 years, then you shouldn't be selling. You just got to stick to your strategy of passively investing your money. What that means is that every month or every week or every 2 weeks, whatever your strategy is, you want to consistently keep passively investing your money into these ETFs. That way you can keep growing your portfolio and keep growing your share of these ETFs. That way you can slowly build wealth and let it compound over time. Stock market crashes and dips are a part of the stock market. What you want to do as a passive investor is build a strategy where you're consistently automatically investing your money. That way your money keeps compounding and you don't even got to worry about it. Your money is going to keep growing, it's going to keep being invested, and now as the stock market grows over time, you will continue to see your portfolio grow. The key for this strategy to work as a passive investor is you want this to be passive. If you're opening up your portfolio every single day and now you're trying to sell or you're trying to buy when markets dip or go up or down, well, now you're not really being passive. If you want the strategy to work, you just got to set a cadence every week, every month, whatever it is, and now keep letting your money invest and compound. That way now you're passively investing your money and you're building shares of ETFs. That way now you're letting the market do its thing. Now, if you are looking for an easy way for you to passively invest your money, you should check out our sponsor Wealthfront, because they make this automation for passive investing super simple. The whole idea here is Wealthfront wants to make investing simple for you. So if you have $500 to invest, you can create an account and answer a few questions. That way Wealthfront can understand you and your goals, and then they will create your own portfolio of ETFs that will work to maximize your returns while minimizing your risks. That way you can try to get the best returns possible from your investment portfolio. Are you guaranteed to make money? No, you're never guaranteed to make money when you invest. But the whole idea here is Wealthfront wants to make investing simple, so now you don't have to worry about trying to find the perfect company or the perfect stock to invest in. They will work to create a portfolio of ETFs for you. If you want to see how it works, let's take a quick look at this product demo that Wealthfront put together. That way you can see what their clients are experiencing. So the reason why I like Wealthfront is, first, they make the investing process super simple. So anyone can start investing even if you have no idea of how the stock market works. And second, they're honest about the type of returns that they've gotten. It really bugs me when you hear these investing apps talk about, oh, if you just put your money in Tesla, you would have made $1 million. Well, that's cool and all, but you didn't. Look, past returns don't guarantee future returns, but you can see that if you have a risk tolerance of 8, what kind of returns that would have gotten you. So if you want to learn more and let Wealthfront invest your money for you with low-cost ETFs, I got the link to how you can do that in the description below. Plus, as a little bonus, they will manage your first $5,000 for free. So if you're one of these people and you're not thinking about retiring in the near future, you should not be selling. If you're over here, if you're an active investor and you're investing in individual companies and you've been keeping up with companies and now you're trying to figure out if you should be cashing out, well, there's a few questions you got to ask yourself if this is the right time for you to sell. If you want to get the best returns, you have to know why you do what you do. So if you're trying to figure out if this is the time for you to sell, you have to ask one of these 4 questions. If you do not fit into one of these 4 reasons, you should not be selling your stock. The first reason why you should be selling your stocks, if you fall under this active investing strategy, is if something is wrong. If you are investing in a company and this company has gone up wildly, but you're starting to see that things are changing. Maybe the executive structure is changing. Maybe their products are not as good as they used to be. Maybe something's wrong with the company. Maybe they're burning cash. Something is wrong with the company and you're worried that this company is going to go down. You're worried that this company is going to go bankrupt. Maybe this company is already going down. So if something's wrong with this company and you don't believe in this company the way that you used to, then that might be a reason for you to sell, because this company is not what you used to believe. When you invested in this company, you believed in this company, you believed in this product, you believed in this value, but now you don't. If that's the case, well then that's a reason for you to sell, because you don't want to just hold on to a company just because you owned it for so long. You only want to be investing in the companies that you believe in. The second reason when it's okay for you to sell is if you need the cash. Maybe you're trying to buy a new home. Maybe you need to buy a new car. Maybe you ran into some financial struggle where you need some cash and now you have cash in the stock market and you have some profits here sitting. Well, this is better for you to sell the stock, pull in the cash, than going into credit card debt to pay for this emergency. So if you have something where you need the cash, well, that's a reason for you to sell your stock at a profit, because you can use this cash somewhere else. The third reason why you should consider selling is if you have a better investment opportunity somewhere else. If you think that one investment will pay you up to 4% a year and a second investment can pay you up to 8% a year and they both have the same level of risk, it doesn't make sense for you to keep this investment when this other investment has the opportunity to pay you a whole lot more, assuming that they have the same risk. And so now you kind of have to weigh the pros and cons between your investments. But if you have a better investment opportunity, maybe somebody has a really cool business idea, maybe you have your own business idea, maybe you find this other stock, this other investment that you really want to invest in, or some real estate that you want to own, and this is a great opportunity for you to invest in it, well then this is a reason for you to pull money out because you found a better investment opportunity somewhere else. What you don't want to do is make emotional decisions where you start to see an investment go up or down and then you sell it and now you're sitting on this cash with no idea what to do next. Sure, there's nothing wrong with selling early and having some profits, but it's also good for you to understand why you're selling. If you can find another better investment opportunity, that's a great reason for you to sell, because now you can take this money, take your profits, and put it into something that's going to make you more money, or at least hopefully, because nothing's guaranteed. And the fourth reason why you should consider selling if you fall into this category is if you win. Let's say you find a company that you really believed in, you bought it when it was undervalued, and now years go by, and now this company is overvalued. This company's stock price has gone up so much, and now it's looking like the stock price is actually a little overvalued. At this point, you've probably made a lot of money and you won. You made the right decision. You found this company when it was undervalued, you rode it up, and now it's overvalued, and now it might be time for you to cash in your profits because you found the right company and you won. You came out of this investment transaction a winner, and so now it's time for you to pull your money out because you got exactly what you wanted. If you want to be an investor, meaning you want to invest in a company for the long term and you're trying to decide if you should cash out or not, and your reasons don't fall into these four categories, then you probably should not be cashing out. Because if you're wondering that, hey, there could be a stock market crash in the future, I don't know if it will happen or not, and I don't know when it will happen or not, and I don't know how big it will be or not, and you're thinking if you should just cash out because of that, well, that's not really a good reason for you to sell, because there's no way for you to predict the future. It is impossible to time the market. This is again where you have to remind yourself of your strategy. If you are an investor, you don't want to be trying to time the market. That's what traders do. An investor is somebody who is going to hold on to a company for the long term because you believe in the underlying value of this company. If you believe in what your company is selling, if you believe in what they do, then you want to own it for the long term. And if the stock market crashes, the only thing that you should be doing is buying more, unless something's wrong with the company. But if the stock price crashes and the company is still good fundamentally, well, this is a great opportunity for you to come in and buy more. So if you are an investor, remember, you got to make your decisions fundamentally and financially, not emotionally. This brings me to the third thing that I want to talk about, which is on everybody's mind, which is what's coming next. So the stock market and our economy are similar but different. The stock market is a place where people go to bet their money and invest their money based off of what they think is going to happen in the economy in the future. So if you want to understand or kind of get an idea of what's coming next in the stock market, you got to start by understanding what's going on in the economy. Because if you understand the economy, then you can get a better idea of what might be coming next in the stock market. The biggest concerns that our economy has right now are three main things. One is the unemployment issue, second is this virus, and third is inflation. inflation. The first thing with the unemployment is right now we have more than 12 million Americans that are collecting unemployment checks, and at the same time we also have millions of Americans that are quitting their jobs because of something called the Great Resignation. People are not happy with their work, they're not happy, they're not getting fulfilled from their jobs, and so now they're just quitting. And so companies are having a tough time finding employees, they're having a tough time keeping employees, and so our entire economic workforce is changing. And so this is a problem because the stock market is made up of companies, and if companies cannot find people, they don't have labor, they don't have employees to work, then companies can't produce bigger profits. So this is something you want to pay attention to, because right now there's a lot of issues with companies trying to find work. On one hand, you have a lot of people that are not going back to work, either because they're scared of getting sick or because they're making more money on unemployment than they would be if they were working, or maybe people don't have the ability to go back physically into the office because now they have to take care of their kids, or if they have to take care of a sick parent or whatever. And so because of that, you have a lot of people that are not working while many companies are not able to find employees. So it's a very strange problem in our economy. This is something that I've never seen before, where you have so many companies that are looking for employees and you have so many people that are not working. So it's kind of a weird situation. And the thing that you want to pay attention to here is unemployment benefits. If unemployment benefits start to go away, how is that going to affect the economy? How is that going to affect companies? And so this is something that we'll see really play out over the next 6 months. But if companies are not able to attract employees, that's going to be a big problem. And that could push the price of products even higher. And if people are not working and the unemployment checks stop, now people are going to have less income, less money in the bank account, and the prices of things are going to be higher, which would make it even harder for our economy to grow. The second issue is this virus. Now, this is becoming even more polarized than it was before, because now some people are really just fed up over this virus, and they cannot believe that some countries are going back into lockdowns, and they cannot believe that people are still talking about this virus about a year and a half into this pandemic. And then you have the second group of people that are very scared of this virus and are now going back into their homes, and they're not going to be spending money again, and they're not going to be going out and doing things again until things settle down again. My goal is not to sit here and argue over what's going on. My goal is for you to understand what is going on. That way you can make smarter decisions with your money. The reality is this is becoming an issue again. We've already seen it in the stock market, where we've seen big one-day swings in the stock market because people are getting worried about this virus again. And if other countries around the world start to lock down again, that's going to hurt our supply chain and our economy, because we live in a world global economy. And so if countries around the world are not able to produce products, we in the United States are not able to produce all of our products. And so that could slow down our economy, which is not good for our stock market or our economy. Not to mention the fact that a lot of companies in the United States thrive by selling things to people outside of the United States. So for example, travel companies. If you're a travel agent and now people are scared to travel again, or if they can't travel again, well, now your business is going to suffer. And finally, you want to pay attention to inflation. So the inflation issue is really hotly debated right now. The Federal Reserve Bank and the government keep saying that this inflation that we're seeing is transitory, meaning it's temporary. But at the same time, you have the same officials saying, yeah, this inflation that we're seeing is a lot worse and it's lasting a lot longer than we expect, and we don't know how long it's going to last, but it's still temporary. Our economy relies on spending. Every company on the stock market sells something. And now if people cannot afford things because the cost of living is so expensive, groceries are expensive, vacations are expensive, and so if people don't have money to afford things because everything is so expensive, then they're not going to be spending as much money, which means companies won't be making as much money. And so if inflation keeps rising way faster than wages, then what's going to happen is now people are going to have less money to spend. If people have less money to spend, companies are going to be making less money. If companies are making less money, companies are going to be hurting financially, which will ultimately hurt the stock market. So this is something you want to pay attention to. Right now, the Fed and the government keep saying it's transitory, but as of now, the price of everything around us keeps going up. So you definitely want to keep an eye on this, because if inflation does not get checked sooner than later, eventually we're going to hit a point where people are going to be struggling just to afford their daily lives, and nobody wants to see that happen. The stock market is not the same thing as the economy. The stock market is the place where people go bet on the economy. They put their money where they believe in companies because they believe in the future of the economy, and the economy is the actual companies. This is where people are going to work. These are the businesses that are making money, and so they're related, but they're not completely the same. Everybody is a financial genius in the bull market because everything you touch goes up, so it looks like you know everything about investing your money, but the real test of financial intelligence is what happens when things go down, because the reality is nothing can go straight up. not even stocks. I mean, we're in a very weird situation because in 2020, when the pandemic hit, we entered the worst recession since the Great Depression. The stock market started collapsing, and as soon as that happened, the Federal Reserve Bank came out and they unleashed the money printer, and then they started propping up the markets. They started buying up assets, they started flooding the markets, and this caused the stock market to go up, and it caused the stock market to rally, and it is continuing to rally. Then we started hearing about the economy opening back up, businesses opening back up, people going back to work. This was great news for the market because now finally things are going back to normal. This pandemic is starting to end. People can start to work again. Companies can earn money. People can earn money and people can spend. But then what we're starting to see is that the economy is not growing as fast as we would like, even though we have all this cheap debt, even though we had all the stimulus money enter our economic circulation. Our economy is still not growing very fast. We're still not where we were before the pandemic, yet our stock market continues to soar. This is great news for investors because if you own any stocks, chances are you've seen huge profits. I know my portfolio has been seeing a lot of gains because we've seen a lot of money enter the markets, and this has propped up the price of stocks. So this is great news if you have money in the market, but that doesn't mean that anything can go straight up. You have to understand that nothing can go straight up forever. The reason why I keep emphasizing that is because we have a massive boom of new traders and investors entering the market. The pandemic and this 2020 recession brought in a massive amount of new traders. Like Robinhood has seen the biggest growth of their platform in the pandemic and during the 2020/2021 crash because this brought in so many new people who want to trade and invest their money in the market, which is good news. But you have to also be cautious because all of these traders and investors are coming in and all they've seen is an upward market. But what you have to remember is that you were going to see ups and downs, and you need to know how to weather the storm, and you need to understand what's really going on in the market because as we start to see the money printing start to go away, as the Federal Reserve Bank starts to stop their money printer, because right now they're still injecting about $120 billion into the market every single month. This is money going directly into institutions to help prop up the markets, to keep people confident in the stock market. And so you have to be aware of what's going on because if things start to slow down in the economy even more, and it trickles into the stock market, because you have to think if the economy continues to slow down and we're not seeing growth in the economy, you're gonna see it trickle into the stock market. You need to know exactly what could potentially cause that. That way you can make smart decisions with your money. The first issue that can really cause a stock market rally to slow down is if more people start to get worried about the strength of the dollar. Everybody's worried about inflation. That's why you're seeing a lot of people now wanting to move their cash to other assets, things like stocks, real estate, Bitcoin, gold. So people have been moving their money into stocks because they're worried about inflation. But if people really start to get worried about the dollar and the long-term health of the dollar, then you might see people move their money out of stocks. Here's what that means. In 2020 and into 2021, you saw a lot of people spending money that they didn't work to earn. They got this money through the help of the government. Now, the government didn't have money just laying around to pay for everything, right? The government has national debt because they spend more money than they have. So the way that they fund these stimulus programs, and it's not just people. You see the same thing happening with corporations, but it's easier to understand with people. So the government now has to print this money out of thin air, and then they give this money to people. Now, when the government does that, they create new dollars out of thin air, and this creates more inflation because now the value of each dollar goes down. But now let's take a step back and understand what this means. People are earning dollars that they didn't have to work to earn, and these dollars are created out of thin air. Then people take these dollars and they go shopping. They go and spend this money. And this money goes to a store who's creating their products overseas. So this money is now being used to buy products made overseas, and now you have these countries overseas that are creating products, and the only reason they're willing to create these products is because they're willing to accept our dollars that are created out of thin air to create these products. So these companies overseas are now taking our dollars created out of thin air, they're creating products and sending us the products. If these companies and countries overseas start to wonder, wait, what is the real value of this dollar? Does this dollar really have the value that we think it does? And then they start to say, you know what, either we're gonna want more dollars or we don't want this dollar, then we're gonna have real problems, because then people are gonna say, wait, I want to be able to buy these products, but you're not willing to sell me these products at this price. I have to pay you 2 times more. Anytime you start to see these big inflationary worries, what you see happen is you see investors sell their stocks and then they move their money to new assets, things like gold, things like land, and nowadays things like cryptocurrency. Or you might also see the investors sell their stocks to buy companies of emerging markets, so countries that are up and coming, that where they're not just reliant on the dollar. This is a pretty unique threat because this is not something that anyone had to ever think about before, but now investors are really starting to think about this because they're worried about what could potentially happen with the dollar if we continue to spend more money than we bring in. So if the government keeps spending way more money and they don't have the tax revenue to pay for this and they just keep printing money to pay for all of their expenses, if countries around the world and people start to question the real value of the dollar, well then that could put a lot of downward pressure on the dollar, which could ultimately hurt stocks. Now you might be thinking, wait, Jasprit, if the dollar becomes weaker because we see more inflation, wouldn't that mean that stock prices would go up? Well, it depends. If a company is dependent upon the dollar because they transact with the dollar and now this dollar becomes less valuable, now this company would in essence become less valuable because everything they own is measured in dollars. It kind of like has a tipping point because in general, inflation can be good for stocks because now when the prices of things go up because the dollar gets valued, you own shares of the companies that are now selling the products at higher prices. And it's not necessarily a higher price, it's just that the value of the dollar, the currency is lower, and so the company has to sell it for a higher price. And if you own the company, then you're benefiting because now the value of your stock goes up. But if you start to see too much inflation because of worries about the actual value or strength of the dollar, then that can be too much, which can cause it to come down. And this brings me to the second thing that can slow down the stock market, which is an economic slowdown. This is probably the most obvious thing because the stock market is supposed to work kind of in correlation with the economy, but it doesn't always work that way. Because if the economy slows, then you might see the stock market continue to go up if people believe that the economy will start to grow in the future. But if the economy is growing slower than expected, this can hurt expectations, which can cause people to now pull their money out of the stock market because they're worried about the future strength of the economy. Our economy is having some serious issues. I mean, companies are struggling sourcing products because of supply chain issues. Companies are having a tough time finding labor because of labor shortages. And companies are having a tough time figuring out what to sell their products at because either they can't source their products or because of inflationary pressures, which are forcing them to sell products at higher prices. And if people cannot afford the products, then they won't be able to sell their products, which ultimately hurts the company. But we also have a less talked about issue, which is really starting to become a problem, which is the trade deficit. This means that the United States is now exporting way less than what they are importing, and we are breaking new record highs with our trade deficit. This trade deficit started to become an issue towards the summer of 2021 because we started breaking new record highs for trade deficits, and we were doing this month after month. And then in August of 2021, it really started to get bad when our trade deficit was getting way worse than expected. And then come September 2021, our trade deficit got even more worse than expected. What this means is we are relying on other countries more than we're relying on our own to create products because we are importing way more products than we're exporting out of the United States. So it's a trade deficit. Now, some people might say at this point that, oh, this is because of the supply chain bottlenecks that we have going on. We're not able to get products in or out of the United States. But if that was the case, our trade deficit would say that we are exporting more than we're importing because our ports are so clogged that we can't bring things into the United States. But that's not what it says. It's saying that we are importing way more than what we are exporting, which is why we're seeing this massive trade deficit at levels that we have never seen before. So why does this matter, right? Because I mean, if we can produce products cheaper in China and Vietnam and India and other places overseas, shouldn't we just pay them less money over there that we can get the products cheap and then bring them into the United States? And in theory, yeah, you're right. Because if we can make the products cheaper over there, why would you want to overpay to get it made in the United States? Sure, we can create jobs in the United States, but if you're looking at this from an economic level, if you can make everything cheaper over there and you can buy things overseas, then how is that bad for us? Well, the problem that this is kind of indicating is that we are not really producing products. And because we're not really producing products, we don't have things to export, but we're relying on all these other countries overseas to create products for us, which means we are more reliant on them than they are on us. And the reason that we're able to pay for all these products overseas is, again, because of our dollar. They believe and trust that our dollar has value. But if that ever gets challenged, now we are in big trouble because now we're trying to buy all these products because we're reliant on the rest of the world to produce products for us. We're hoping and praying that they will continue to accept the dollar as payments for all the products that we need, but if they don't, now we're in trouble because we're reliant on the rest of the world to produce all of our products, and now we don't have a way to pay them because they don't want the dollar anymore or because they want more dollars, and now we're not producing enough to create income within the United States to send this money out. So we need products created by the rest of the world more than they need products created by us, and this is only able to sustain as long as people continue to value our dollar. And then we have a surprise, economic slowdown because the country is not growing fast enough economically. And everybody thought that, hey, our pandemic is over, people have this pent-up demand, they have all this extra cash, they're gonna go spend, and our economy is gonna start growing and it's gonna start booming. But our economy is not growing as fast as we would like, and in fact, we're seeing the economy actually start to cool down. It's slowing down, which means that now we're running into a tough issue because the government thought that they could just stimulate our way out of this pandemic to get our economy roaring again, but it's not working fast enough because our economy is still slow and it's actually slowing down. Even Amazon's starting to get worried because they're saying that spending is slowing down and they don't know when it's going to pick back up. I want to highlight one paragraph from that Fortune article. Here's what it says. After Amazon gave a not so good outlook about the economy in July, everybody thought that things would be better now. It says, quote, I think people were hoping that this quarter would be the bottom, and now it doesn't seem like that's the case because some of the challenges that they laid out in the summertime of 2021 didn't get worse, but they didn't get much better either. So Amazon, like other retailers and companies, came out in the summertime of 2021 and they said that yeah, things have been booming up until now, but we're kind of worried about the future because we're starting to see things slow down. And then everybody assumed that this would be better by the end of September or at least by October of 2021. And now Amazon's coming out again in October of 2021 saying, yeah, things are not getting better and we don't know when they're going to get better yet. Our economy runs on spending. If I take $100 and I go to your restaurant and I buy a nice meal, well, now I spent my hard-earned money at your restaurant. You made $100 and now you can take this $100 and reinvest it back into your company. You can use this money along with everybody else's to open a new store. You can hire more employees. You can invest in more options on your menu. And so now if I spend money in your restaurant, you have money to grow, expand, hire more employees, and grow the economy. If I don't spend money, either because I'm worried about the economy or because I don't have any money to spend, now you don't make that money. And if people are not spending at your restaurant, now you don't have the ability to open a new store and hire more employees, and you might even have to let some of your employees go. This is something you have to pay attention to if you're investing your money, especially in the stock market, because if you're investing your money in the stock market, you're investing in the future growth of the economy, and if the economy is not growing fast enough, that's not so good news for the stock market, which is why, again, you need to understand what's going on, that way you can make smarter decisions with your money. And the third thing that you got to pay attention to, which can bring the stock market down, is if people run out of money. Stocks, just like every other asset class, run on supply and demand. When you have more buyers than sellers, this pushes stock prices up. So if you have a lot of people that want to buy the Tesla stock, then this would push the Tesla stock price up because now when you're selling the stock, you might have 10 buyers trying to buy your stock. And this will help you push the stock price up because now you can sell your stock for a higher price. But you also see the flip side because now if you have more sellers than buyers, you have a stock of a company which is now on the verge of bankruptcy. You're not going to have that many buyers. And so this is what brings the price of stocks down because now you're going to be forced to compete against the other sellers to get a buyer. So now you might be cutting your price to sell your stock, and this is what brings prices of stocks down. So when you have more buyers and sellers, stock prices go up. When you have more sellers than buyers, stock prices go down. Anytime you see a point where investors are fully invested, well, this is good because now that means the stock market has risen a lot because a lot of people have put their money into the market and they have put all their money in the market, which has helped stock prices to go up. But now you don't have any more buyers left because everyone's money is in the market. And so now if someone tries to sell their stock, they're going to realize that there's no more buyers left and they're going to have to cut their prices to incentivize somebody else to come in and buy these stocks. There's a couple ways that you can figure this out. First, you can actually just go and look and see how invested people are. In the middle part of 2020, we saw investors sitting on the biggest piles of cash ever. That means you had all this cash sitting on the sideline waiting to be invested, which is one of the reasons why you saw the stock market essentially go straight up from mid-2020 until the later part of 2021, because now investors started to come back into the market and you had so much cash sitting on the sideline. It got a lot better in 2021, but you still have a lot of investors that are sitting on cash, which means you still have a lot of potential buyers that are just waiting there for the right opportunities, which will mean that if stock prices come down a little bit, these buyers will come in, which could help stock prices go up up even more. And then you can also look at interest rates, because if you are a person or an institution and you can borrow money very cheaply, well, now you have easy access to cash, which then you can take and put right back into the market. But if interest rates start to go up, now all of a sudden it's more expensive for you to borrow money, because let's just say that you can borrow money at 3% right now, and then later on you'd have to borrow money at 5%. Now that means that you need to get a better return on your money for it to make sense and justify you borrowing money. But when interest rates are dirt cheap, now you can get a very low return on your money and still be profitable. So right now we have historically low interest rates. It's a little bit higher than it was in the middle part of 2021, but they are still historically low. That means you have people and institutions borrowing money and putting this money into the market, which is bringing more buyers into the market. But if we start to see interest rates go up, which eventually you would think that they will, but when interest rates start to go up, that would make borrowing money more expensive, which would make it less likely for people to now go out and borrow money and put this money in the market, because now you're going to need a better return on your money. And if the economy is not growing that fast, then you're not going to think that you're going to get that same higher return to justify borrowing this money, which could bring less buyers to the table. Plus, one day when the Federal Reserve Bank stops their asset purchases, that would also be another $120 billion or so that are entering the markets every single month. I gotta make these videos not to alarm you, but to educate you. That way you understand the different factors that you need to pay attention to. That way, if things start to slow down, you're not caught by surprise. You expect it. That way you can make smarter decisions with your money. The cost of things are way more expensive now than it was just a year and a half ago. Because of that, it costs a lot more money to build a home, which is also pushing home prices up. The hope is once the supply chains start to normalize, and once the economy goes back to normal, and once more people go back to work, the cost of materials and the cost of labor will start to go down and normalize a little bit. But we don't know when that's going to happen and if that will happen.